Global yields, central bank moves, and domestic policy actions are shaping the debt market. From geopolitical risk to local inflation trends, debt investors have much to watch this month. To help us understand this landscape better, we have with us Mr. Abhishek Bisen, Head of Fixed Income at Kotak Mahindra Asset Management Company Limited, to share his perspective on global cues, India's positioning, and investor considerations. Welcome to the show, Mr. Abhishek. So, first of all, I want to understand how are the recent geopolitical tensions and US trade tariffs on India influencing the global bond yield, especially the US Treasuries? And what are the most likely spillover effects on India's currency, inflation outlook, and domestic debt markets?
Good question, Astha. So, we are clearly living in an event driven uncertain times. Over and above that, this tariff situation has complicated the situation even worse. However, the real question is, can we afford a 50% kind of tariff? The answer is no. At the same time, is this likely to sustain for the entire year? The answer is no. So both the countries put together are likely to mutually agree on a much more sustainable, economically neutral kind of rate for the tariff, and therefore it is unlikely to have a meaningful impact on the Indian economy. Now, as far as US economy is concerned, these tariffs are definitely a fiscally positive event for the US, and therefore should have a positive impact on the bond yields. At the same time, given the mixed set of data the Fed is getting and the possibility of a rate cut in September has just increased, therefore, any negative impact on the US is very limited.
So India has been recently upgraded to triple B by S&P, and foreign portfolio investors have shown mixed participation in Indian debt. Do you expect this trend to change in near future considering the recent yield differentials?
Indeed, it is a very positive development and has come after almost 2 decades. This is a structural event, and the benefits takes time for its positive impacts to be shown. Undoubtedly, yes, we do expect a reasonable amount of positive impact on the Indian bond yields over a period of time. As of today, we are just included in two of the bond indices by FTSE Russell and JP Morgan. So the flows at this point in time are limited to those indices. But this rating upgrade will definitely help us in getting into other indices, and therefore we see situation becoming better over a period of time. And given the flows, it will have a positive impact on the currency as well.
So, Mr. Abhishek, given the GST rationalization, what are your views on government borrowing and its potential impact on the bond yields this quarter?
So this GST rationalization, at the face of it, is a fiscally negative event. However, we have seen that when the rates ease off, it normally leads to volume growth and therefore unlikely to have a meaningful impact on the fiscal. At the same time, this is only likely to impact for the 6 months of the year. Therefore, the impact even is more limited. The real question is, we'll have to see how do they adjust for the next financial year borrowing program. As far as this year is concerned, since the impact, as I explained it to you, is likely to be limited, and government is having reasonable amount of fiscal space, we do not see any spillover effect on the government borrowing program. At the same time, the market has overreacted on this particular news, and yields have corrected significantly. 10-year bond yield, as we speak, is trading at 662, and the 30-year is trading at almost 735, 740, is discounting major amount of negatives in the bond prices.
So, can you tell us which segments of the debt market, for example, government securities, corporate bonds, or money market instruments, appear relatively better placed in today's environment?
So, as far as the yield curve is concerned, the curve has steepened significantly, which makes the longer end relatively more attractive than the shorter end. However, If you are looking at lower volatility and safety and you have a shorter investment horizon, then you can look at the shorter end of the curve. But if you're looking for value and have a long term investment horizon, you can look at the longest end of the curve.
So, with the RBI maintaining its policy stance amid the ongoing market volatility, what is the near term outlook for interest rates and liquidity conditions? And what are the investment horizons debt investors should consider in this kind of environment?
So, as we discussed, the macro backdrop is pro easy monetary policy. With GST rationalization, also it is likely to have a positive impact on inflation. Monsoon clearly is favorable for inflation, and the near term inflation outlook is benign. With that, we believe there is still chance for one more rate cut going forward. At the same time, market on the other hand is discounting possibility of a hike much more sooner than later, which makes market slightly more attractive for the investors. As far as investment horizon is concerned, actually it should be the other way around. Investors should choose product in line with the investment horizon. However, if they choose the longer end of the product, longer end of the curve, which is relatively much more attractive as of today, the investment horizon should be more than 18 months and they should be okay with tolerating volatility.
Thank you so much, Mr. Abhishek, for joining us and sharing your valuable insight on debt outlook.
Thank you.
We hope this discussion helps listeners to gain some perspective on opportunities and risk influencing the fixed income market right now. For more such information, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.